All right, let me just quickly look at the calendar, and then we're going to get into it with Mr. Bill Predebon, Billy the Bulldog. All right, December is a full month. All right, we got to have a Power Week last week with education and Super Saturdays. We mentioned mainly we got Super Saturday with Richard Stock as well. Two property tours, one online, one in person. And the Thursday iOS train. We need to be there. We need to see how these uh, inputs from the AI, the MLS, the county recorders, all those things come together in one spot and make your decision making a lot easier. If you like driving around for dollars and banging on doors and leaving notes everywhere, great. That totally works. Done it. Got deals from it. But maybe your schedule doesn't allow for that. Use the software and also, folks, sell the software. I don't know if you know this, but you actually get a commission on everybody who buys a Renatus iOS subscription or package from you. Okay, they can pay the 125 a month and get that whole suite of tools. If they want to throw on an extra, I forget what they call their package, um, but it's a one-time fee of $1,000, and you get a commission out of that too. So really, if you sign up 4 people on the monthly subscription, your Renatus iOS software will be paid for. You get $30 per subscription. So if it's 125, you need 4.16 subscriptions. Earl's going to check my math at some point and let me know my decimals. Yes, good morning, Zen. GM to you. Hi.
Good morning. Uh, Strange question. Do they have to be already a member, obviously, in order to, because, for example, could that be a bridgeway
No,
into,
no, it's
okay,
a
so they have to
members
be a member.
only work.
Okay,
Yeah,
perfect.
if
Thank
they
you.
were to arrange all those other things outside of our membership, it'd be like $400 a month.
Okay, perfect.
So
Thank
that's
you.
a deal that we worked out saying, hey, if you become a student, we're going to give you the discounted tool as well. There are some companies that don't do the robust education like we do. They only sell software, but they
Yeah.
sell it for $500 a month and then a coaching thing on top of that. And it's just software.
Wow.
So my point in bringing that up is that there's a huge demand for it, so much
Okay.
so that people build entire systems around it. It's neat, but we love our education so much that sometimes we don't talk about the software tool, and sometimes that's all people want. And then they look at the education as a nice little, side snack, and they think that the software is the meal.
Okay.
So depends on what your
Perfect.
clients and students are looking for. But yeah, that's it's valuable for them to use, and it's also valuable for you to sell.
Thank you so much.
Yeah, sweet. Yeah, because our main developer at Renatus iOS um, is not Jenna. She's great, but she's more of the front-facing stuff. We were talking to the developers, and they have some people who, their companies are signing up 5,000 people a month just for software. And so what I took from that was that way more people want it than we understand, and we hardly ever talk about it. And so we should bring that up way more in our conversations. So perfect. Takeoff Tuesday. Mr. Bill Predebon is in the house. And I put out the message, be the 1%. I think that the mindset, the framework for people like Bill, like Dane, like Mr. Snyder are in that 1%. And that the more we spend time with people thinking in the 1%, I often joke that one of our missions is to turn the 1% into 2%. Let's do it. Let's double the amount of wealthy people in this country. We can do it. Let's go from 1% to 2%. And it takes a certain tenacity, it takes a certain willingness to sacrifice and stop doing time wasting things or inefficient methodologies for building your business and building your relationships. But I love what Bill has done. He has come into our program, nearly 2 decades ago, and has been just blowing the top off of so many things. He's got properties on the East Coast, the West Coast, touching the Canadian border, touching the Mexican border. The dude is all over the place, and is living a life by design. That's something I admire about him. He uh, has done short sales, fix and flips, wholesaling, lease options, short-term rentals, long-term rentals, seller finance notes, auctions, raising private capital into the tens of millions, and has done hundreds of deals. And the guy's just always smiling, and is a great example of what happens if you get focused and committed to your better future. So we're very grateful to have him here this morning. So let's give a big warm welcome to Mr. Bill Predebon, GM.
Good morning, brother.
Hey, hey, great to see you.
You too. What's up, folks? Thanks for that intro, Mike. That was pretty impressive.
You know what? You are impressive. Sometimes when people think, I don't know, should I join Renatus? And I just say, Bill Predebon. And they go, all right, I'm in.
That's awesome.
Yeah, man. So thank you for being a great example and being consistent, showing up week after week, helping support on the marketing side, on the real estate side, and just being a general badass. We really appreciate you.
Yeah, right on. It's been a pleasure. I mean, I appreciate everybody's commitment and everybody's participation, and I appreciate the honor. I mean, it's an honor to be here. It's you know, something I've wanted to do, and I'm grateful. I'm grateful that you put this opportunity together for everybody. And boy, this is with Dane Clark on Wednesdays, and the three of us. It's a great opportunity for people to share with their prospects. Be on these calls, and it's pretty good collaboration. A lot of good. You have a lot of good information, obviously, actually great information for ICMs. Morning, Doug. What's happening? Hi, everybody. Yeah, so let's make this call about you all, ladies and gentlemen. Looks like Tamara's got a call already. Morning, Aubrey. So, Tamara, if you want to kick it off, that's good with me.
Yeah. So awesome. Good morning, everyone. And as always, Bill, appreciate you being here. So I have two questions. Let me start with my second question. So I have a potential private money lender, and he proposed two things. He proposed I think an equity position, which I've never done. And I know you've talked about doing it before. So I was curious to get your perspective now on that, and some ideas to how to structure it from an equity position. And he was also asking me about the back end. I have to ask my attorney about this because it's a seller finance deal. So what he asked me, which I like this question, he's an investor, not educated, but an investor, is if the tenant were to default, would would the tenant get the equity of the property, or would I get it? Because I didn't know that. I had an inclination, but my question to you is, how would you do equity splits for a private lender?
Okay, so let's define a few things. And there's no definite answer or definition necessarily, but let's be clear. So debt, especially when you work with commercial lenders, debt is typically first position. It can also be second position, but debt um, is the amount of money normally that someone will lend. And when I say someone, it could be a traditional bank, a hard money lender, a private money lender, and they will lend at a lower LTV at a lower interest rate, and they will create the debt for the property. Um, that means that they usually lend less than the property is worth. right? Whether it be an ARV, an after repair value, or even an as is value, right? When they're purchasing. So a lot of times if you buy a home, even on a retail side that you're going to live in, right? You get debt from the bank, 80%, 90%, 95%, 97% if it's an FHA, right? But you come in with the equity. You come in with the difference because there's still equity in the property if the debt is less than what 100% of the property value is. So that's the debt, right? The equity is the difference. So normally when we're doing a fix and flip or some sort of real estate transaction, we are creating equity through acquisition cost, right? We got it at a discount. We're creating it through value add. We're adding square footage or building the property from ground up, or we are doing a fix and flip. We are forcing appreciation through improvements. Okay. So, and therefore there's an after repair value, but we're still typically buying the property at an equitable position. So the equity partner is what he means by equity, right? So equity does not mean that you need to be a partner with that person. Equity means I want to be in the equity position. It's typically going to be a higher interest rate, right? They're taking more risk. If someone in second or third position has to foreclose on the property, as you know, they have to pay off the first, right? Even if the first is in current good standing. If the first is not behind, but they stop paying on the second, then the second would create the foreclosure. The first would be notified and they would want all of their money back, right? Because they're in a debt position which has a lot of equity, right? Now, I'm guessing what he means by would the tenant get the equity? No matter what, in the case of a foreclosure, the owner will get the amount of money that is over and above all of the debt and fees, right? So whoever forecloses hires a company, typically a lawyer, a law firm, to force the foreclosure in the legal process. So it's done legally properly. Their person's notified, the public's notified. If it's a judicial foreclosure in the state that it's in, it's all done properly, like by law. So there's fees there, right? And then there's late fees, back due interest, back due payments. All these things are added up. The lawyer and the law firm that, or the judge that's doing the foreclosure will add all these things up, and that will be the debt on the property. But if the property has a lot of equity left in it, and I come in and buy it at the auction, and I pay more than is owed to all of the lenders because there's a bidding war on this property and there's equity in the property, right? Like if the property's worth 250,000 and the foreclosure is for 150 and someone pays 175 for the house, there's 25 grand left of money that goes into a pot and it sits in an escrow account in the county where it's foreclosed on, and that money's due to the seller. So the answer is if you're selling the property on an owner finance deal, which means you've transferred title to the tenant, then in a foreclosure, the tenant would be entitled to anything over and above the all of the debt that was owed, right? So if let's just say the tenant stops paying the first and your partner, your friend that puts in money on this deal is in second. If the first is you or the bank that is subject to whatever the first is, however they're paying it, the first would notify any other lender of record. And technically, it's not the banks that's going to notify them, it's the lawyer. By the way, the property you have a lien on in certified mail, you're going to get a notice that says it's going into foreclosure and they're going to foreclose. So you're going to claim a stake to the property, right? You're going to be in a debt position and that equity partner, and then you're going to want to get paid off. You'll get whatever's left after the first, the fees, the lawyer, the judge, whatever, all of the back due interest, all the fees, the fee to pay the lawyer to foreclose on it, all those things are paid. The rest of the money will go to the second lender. If there's an abundance over and above the second lender, it would then go to the owner, or what would be the in this case, the 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 tenant, which is a owner carried individual. If it's a lease option, they would not get it. You would get it. The owner of the lease option would get it. Does that make sense?
Yeah. So anything over and above the debt owed, I would get equity wise.
If it's a lease option, if you
No.
transfer title to the whoever the owner of the property is, like if Michael gets in a hardship and he goes into foreclosure, in Maricopa, there's like I can't remember the number. There's like $5 billion of money sitting there from foreclosures that people that own the houses haven't claimed, right? Because there's a bidding war on a lot of properties because there's like if the first is only 100 grand and the house is worth 250, right? It needs some work, whatever. And someone goes in, the lender that was owed 100,000 is going to put up the opening bid at 100,000, right? They want their money back plus fees. So I might go in and offer 101,000. And then some other guy offers 110, and the other guy offers 120, and I go to 130. Well, there's $30,000 over and above what's owed to the people. So it just sits in an account. It's actually due to the seller, to the person that got foreclosed on. But they've moved on. They've moved out of the house. They don't even know this information. There's companies that strategize in reaching out to people that have lost their homes, and then they take 50% once the people go back and claim the money. They help them go claim their money that they got in the foreclosure. It's a big business. So to answer your question, you would get in a foreclosure situation, you would get the equity if it's a owner finance deal. I mean, if it's a lease option, but if you transfer title, the owner of the house is now the tenant. It's now the person paying you the owner finance deal. They have title to the property. Does that make
So
sense?
um I think so. So it's owner finance now. So they get the equity.
Of course. That's part of being an owner finance. That's why if I sell a house on an owner finance deal, I'm selling it at future price. I'm not selling it at today's market. So I typically do 6% to 8% a year, right? And round up. So let's just say I sell a house on owner financing for 100,000. Today it's worth 100,000 and I owe 80, right? And I sell it on a 3-year lease option. I'm probably going to sell it for 120, right? When it comes time for them to buy the house, typically in the paperwork, there's either two appraisals and you split the difference, or you would get an appraisal and you pay for the appraisal, or they get an appraisal and they pay for the appraisal, right? And if they're going to get financing, then the bank's going to pay it. And if it doesn't appraise, you don't have to sell it. If it doesn't appraise, they don't have to buy it. Or you come to a meeting of the minds of what you're going to sell it for, or you may put in your terms that if it doesn't appraise, the only way you're selling it is if they come to cash over and above what the lender will give them, right? Because you're not going to sell it for less than 120 and it only appraises at 118. So it's up to you in the terms that you create on the lease option. I mean, on the lease option, on the seller financing. I'm sorry. I'm confused on my lease option and my seller finance. So, if someone buys it seller financed, you typically put the price at it's sold that day. It's sold that day. It's recorded. You sold it for 120,000 and they make monthly payments. You pay the debt, whatever the case is. But if it skyrockets tomorrow and it goes up to 200,000 and they want to sell the house, they get all the equity.
Right. They would just have to pay my note, right?
Well, of course, they have to pay the first.
Right. And then yeah.
But
So
if there's a second on it that you created, they don't have to pay that, right?
So how, okay, so that this is good. I haven't really thought about stuff like this, but how would I make him an something appealing enough for him? He's asking about he wants equity stake. Usually I just give a percentage to people who come in as private money lenders. But he wants equity stake and I don't like so and he also asked, well, what happens if you foreclose? Like I didn't know how to answer it. I didn't have a quick answer for it.
It's okay. So um it's fairly simple. It's just when when we haven't done it. So folks, so an equity partner is an option that I offer all the time, right? Now, the easiest way is just give someone bringing in the money 50%, right? I think that's too much. Um, so here's the deal. When I don't know exactly what you need an equity partner on a seller finance deal for. Can you explain that to me?
Yeah, so I had a private money lender. I used a private money lender to buy the house, and I was paying her, um, I don't know, like let's just say 8%. And she's been happy with it, but she needs the money out now.
Oh, so you got to
So
get her out.
yes,
So you got to pay off the first.
yes,
So yeah, so he's going to come in, pay off the first. He's going to be in first position lien. But instead of lending you the money, he wants to be an equity partner.
right.
So how much equity is in the property? Have you
Um,
have you already sold the property on owner financing?
yes.
Okay, so how much do you owe and how much did you sell it for?
I sold it for 63. It's a small property, 63 or 65. And I need to get her 46,000.
Okay, so how long's the lease option? I mean, how long's the owner financing?
It'll be 30 years.
You're giving a 30-year, you're financing it for 30 years?
No, I didn't set that yet, but I need to go back and watch the note class. This is the new part for me of
You
seller
don't need to know,
finance.
you don't need to go back. Well, I mean, I mean, definitely go back and watch classes, but what, uh, you said 46,000?
Yeah, or I could do it for 10 years if that is, are you thinking I should do it for less time?
So, well, I mean, that's up to you. I mean, it's entirely up to you, what you want to do as far as how long you want to be a bank for. Um, Typically I would put in a balloon to get the thing off my books, but if, um, you know what I mean? So eventually, people owner finance because they can't qualify for the loan, but eventually they get their shit together so they can qualify for a loan. So it's a you put a balloon in there in 5 years or whatever. But if you want to carry it for 30, I mean, most people don't keep houses for 30 years anyway. They sell them or refinance them or do something with them in 7 to 10 years, as you know. So typically at that point you'd be paid off if they sold it or refinanced it, right? Um, she's iPhone, they said the interest rate was 8% to the $46,000 lady, which is 306 a month, interest only. So um
So then
so
let's move it to a 5-year balloon. I haven't gotten that far in my head, but I'll move it I'll throw it out as a 5-year
yeah,
balloon.
it's not going to matter. So
Okay.
he's going to get, so if he wants to be an equity part, so number one on equity, folks, the difference between debt and equity, in my opinion, is there's there's risk to someone lending you money and putting a lien on a property, but it's very little risk, right? Because A, they can foreclose on the property, and B, you have a promissory note to pay back the money, right? So in theory, if you borrow money and the lender lends you money in second position and they get foreclosed on and they don't get all their money back, then they have the opportunity to sue you because you promised to pay them a certain amount of money, right? With interest. So that that lender technically is owed that money no matter what happens and what you do with the money or where it goes or what happens in the deal, right? Um, so that's why it's a lower interest rate, typically lower risk for the lender, secured by property, and they're getting a good deal, right? And everybody wins. And if you screw up, you pay for it all. And if you don't pay them back, they can sue you because they have a note. An equity partner is a partner. If the shit hits the fan and the property goes south and so on and so forth, then they take risk with their money. You take risk with your time and knowledge, right? You don't put any money in, but you got the whole deal. So all this work that you did goes south. So if I'm going to have an equity partner, I'm not going to promise to pay back a dime, right? And then since I'm doing all the work, I found the property, I found the seller, I sold the property, I did all these things. I might give up to 35% max of, depending on the property, of the equity, right? So if you collect a check for $400 a month in rent, then they get 30% of the rent. And then once you sell the house and they close out, whatever difference is left over what you got, in this case, if he gives you 46,000 and you sold it for 63 and there's $19,000 of equity in the property after closing costs, then he would get 30% of the equity, 30% of the 19 grand, and you would get the rest. So you'd split every profit 30%. You would split rents, you would split you could make up your mind in the beginning who gets the depreciation. If he wants depreciation, then he would get 30% of the depreciation and you would get 70, right? If your deal was 30% equity. But if anything ever went wrong with the property, then that equity partner does not get paid back. If there's losses, you would determine how the losses are handled. Generally speaking, you want to try to make the financial losses be on the burden of the equity partner because they wanted more of the pie. They didn't want an interest rate and a guarantee. They wanted to take a risk to make more money. So therefore, if their money gets in trouble, then they have to pay for that risk, right? That's an equity partner.
Wow.
When there's more than, if you become an equity partner in a firm, however, right? Then, and to be honest, if this is true, and you want to spell this out, but an equity partner, folks, in any LLC, right, in any situation, if it's written out properly, they're responsible for financial downfalls, right? So when there is a capital call, when you're doing a fix and flip and you run over money, right? You don't have enough money and you have an equity partner in a fix and flip. If it's written out properly, then they need to bring more money to the table. You're not the money lender, right? What happens in a fix and flip if it goes over time and it goes over budget and there's issues, right? Then you as the hands-on worker of the deal, right? You have to put in more time. It's not sold at the time you thought it would sell. Therefore, you have to continue to maintain the property. You have to do extra work to keep the bills going. You have to raise more capital, or you have to, right? And you have an equity partner. If you have an equity partner and they'd agree to be an equity partner and they put in 50 grand and you need 60 at the end of the day because you need to carry it a little longer, that's their job. So it's a capital call. And technically, if someone doesn't pay and they're an equity partner, what happens in an LLC where there's 4 of you? And there's a capital call because the business you started needs more money because it hasn't gotten paid yet. And there's a capital call. The one person who can't put in their share is considered, space in the name, is considered insolvent. And therefore, they actually lose their equity. They lose their position and they're kicked off the LLC, right? If somebody is insolvent and they can't contribute, they're no longer valuable to the partnership, right? So if the guy puts in $46,000 and you don't have any insurance and the damn house catches on fire and you got to fix it for 20 grand, he's the equity partner. He's got to put in the 20 grand. If he doesn't, he's insolvent, he's out. Now you still have to come up with the 20 grand. So now you can offer equity to somebody else who has the 20 grand. but that guy's out of his money. So there's a difference for being an equity partner and being a lender. Lenders lend money, that's it. Once their job's done, when their money's due, when the note's up, it's time for them to collect. You either extend or you offer, you get an extension, or you work out an agreement, or you pay them back, or you buy them out, or you get some other lender to take them out, just like this person is. If this lady wants her money and you don't get it back and you can't find it, and you have a note with her that's due, then her recourse is foreclosure. So you don't have any risk. The equity's lost. I guess your risk is that you're not going to get your 19 grand, right? But that's a whole nother animal, because then you have to deal with your seller, because the buyer's not in foreclosure, you're in foreclosure. So let's go back to this. So it's pretty important. So if I was going to structure it, I would make clear. So in my agreements, if my person that is an equity partner does not come up with the money when I need more money, right, on a deal, then if I come up with the money, I'm going to get paid to do that, right? And that's going to come off the top of our agreement. So not only am I going to raise money between 10 and 30% to finish the project, right? I'm going to get paid to raise that capital. So therefore, if we would have made 100 grand and I'm going to get 10% to raise this money, then I get 3% out of the 100 grand right off the top that I'm not giving to the equity partner, because I had to bring in extra money. Because the equity partner's job is to provide money for the project. It doesn't mean that I am a perfect 100% accurate on how much money that means. I don't know when it's going to sell. I don't know how long it's going to take to sell. I don't know how much it's going to cost to fix up. It's all estimates. So yes, I'm asking you to borrow 100 grand to get this deal done, but we might need 120. Are you in for 120? If I need more money, are you going to have it? If you're not, then here's the deal. I'm going to raise the money. I'm going to get paid, and it's going to come off the top of what would be the equity. Right? Otherwise, that equity partner is insolvent. And if they don't come up with the money, an insolvent partner is of zero value to any company.
So, got it. Okay.
So I would say, so the answer, he asked you what happens to the equity if the tenant doesn't pay, right? It's just a normal foreclosure. So he's the equity partner now. There's no more debt. He's taken out the debt. So he's going to be owed, let's say, 50 grand, right? Then you would hire an attorney, right? Because you're the bank. It's a seller finance, right? You're the bank. He's the lender. You guys would hire an attorney. You would foreclose on the property. Someone would come in and buy it, a third party, or you would have to buy it back, right? You would get the house back. Since you are the lender and no one bids on the house at whatever auction, whether it's private or public, the property will go back to you, and now you get all of the equity, right? So if it's worth more than 63,000, right, you already get 63,000, right? So you're going to foreclose for 63,000. You're not going to foreclose for what you're owed, because you're owed a second mortgage of the 19,000 of equity. Does that make sense?
yes, because they're on a note.
Correct. You should have a second position. I mean, you don't have to put your own second position on there, but you might as well do it, right? Because they're paying for 63,000, they're not paying for 46, but he's only putting in 46, right? So now you got to split the 19,000, whatever percentage you're going to give him. But when you go to foreclose, if she stops pay, if the tenant stops, or what would be the buyer stops paying you on the 63,000, you're going to foreclose on 63,000. But if the house isn't worth $63,000 today, then no one's going to bid on it for more than 63,000. if you had to foreclose. Does that make sense?
Yes, no one's gonna bid in a to take it on in a foreclosure. Right.
No,
They want
because
under.
it's not worth what you need to recoup.
Right.
Now, you could take a short. Is everybody following me on this? You could take you're the lender. You could take a short on your second. So you could technically offer the house at 50,000 and only make 4 grand, right? You'd no longer make 19 grand. But why would you do that? You have a chance to take the house back and resell it on another owner financed. So the guy puts in 46, you sold it for 63, you put it up for auction at 63, nobody buys it, it goes back to you. You own the property, but you only technically owe 46 on it again. So now you set it out and you resell it for 75 on a
So
on a new owner finance deal. Yeah.
so what he was yeah, what he was asking me also, and I just want to be prepared for this conversation, is kind of like down the lines of what you're saying. He's like, well, what if I want to sell the note later? Which, again, I've never had someone, and I'm just coming in as a lender ask me this, so it's good, but I haven't had the conversation before. So, I like how,
So
like,
that guy doesn't have a note. Number one, he doesn't know what he's talking about. If he's
okay,
an equity partner, he doesn't have a note. He might have a lien on the property, folks. There's a difference, but he doesn't have, no one's promising to pay his ass back, right? You're not writing a note with the guy. You're not borrowing his money anymore. If he's an equity partner, so he can't decide to sell his note. You would have to decide to create a note and sell it together
right.
because there is no note on an equity partner unless you're doing a hybrid, right? So, so if he's like later on down the road, if I want to sell the note, well, you'd have to sell the ownership, you'd have to sell the equity that you guys own to somebody else, and you'd have to create a note so you could sell it, or you know what I mean, or you sell your position. Now, if he wants to sell his equity position, that's up to him, right? If you've got 30% equity and he's owed 46 and he put in 46 grand, he would have to take himself out, right? He'd have to find someone else to pay you 46 grand and pay you your equity so he could get his equity.
So that would be on him.
Of course it would, or you guys would have to agree to it because you're a partnership. If you're an equity partner, you're a partner.
Um, is equity partner the same as equity st and this is fantastic, by the way. I'm taking notes. Is this an equity partner the same as an equity stake?
No.
What's an equity stake?
Equity is created by being where the value of something is worth more than it's owed on the something, right? So if you think about the value of the house as a homeowner, we all can relate to this, right? We're going to buy a house. We buy a house for 100 grand and the lender gives us 80,000. There needs to be the gap is what is considered equity stake, right? There's still equity that needs to be covered. So the second position lender, right? Even if you have in a more common place for that, right? Even though the second would be considered debt, it's equity above what the first debt is. Now, typically in a more common arena where we're playing with this money is you get debt to buy an apartment complex, for example, or in this case, this house, right? And then there's equity needed for all of the other things that are involved in the business. And that equity stake, right, is sometimes a loan. And then that loan will be offered a piece of the equity in addition to a loan, right? They're not a partner, but they're an equity stake, right? So they're going to go in with all the money that's needed to gap fund the project, any missing debt when it comes to the purchase price, and then any capital that is injected into the property to increase the rents to stabilize the business and that sort of thing. And for that, they're going to get an equity stake in the property because normally, right, when you improve a commercial building, apartment complex, any type of business, then the business value goes up. Why? Because you've increased the income and decreased the expenses. So the value is based on an income approach, right? Whether it's a business, whether it's a apartment complex, whatever it is. So there is an equitable stake at stake in that business by injecting capital into it and stabilizing it and increasing income and decreasing. And now it's got more value. You've created equity through the process of improving the building, decreasing vacancy, submetering increasing income through adding additional income streams on the property, whatever it is. So in a lower term, in a lower example, on a fix and flip, right? And then an equity partner has to come in, make up the difference for the gap funding, right? Because you're getting the debt for less than you owe to buy it, right? Unless someone's giving you 100% financing, which isn't typical from a hard money lender, you're getting 90%. So they got to gap fund the difference, right? And then they also got to give you money to improve the property. By improving the property, it's increasing the value. When you increase the value, you've created equity. When you create equity, now you have an equity stake, but they're typically a lender with an equity stake in the property. Does that make sense?
So that what you I'm not clear on I'm not so okay, I get the concept of what you're saying. What I don't understand is how that would apply to my this situation.
It typically wouldn't. I wouldn't complicate it with the guy. He's
I
gonna
didn't. He asked me that.
right. I would say you want to be an equity part. You want to be an equity partner, or do you want to be a lender? Right? There's an opportunity to be a lender and an equity partner, right? I'm going to lend you the money you need. I want you to promise to pay it back. I'm going to put a lien on the property and I'm going to have a promissory note and I want an equity stake in the property. Okay. That's a hybrid. He's going to get both being a lender and he wants equity, right? So then you have to share. So in that case, I might give them, like on Shark Tank, 10%, right? I'm not giving you 50%. You have no risk. So they want more for their money. So I might give them 10% equity. So if you cash out and you guys make $19,000 over 30 years plus your rental positive cash flow, then he's going to get 10% of his rental positive cash flow and he's going to get 10% of the equity. In this case, if they carry the term for 30 years, there's no balloon payment. So he's only going to get his equity over 30 years, right? But he's also going to get 46 grand plus an interest rate because you've paying him on a loan that you borrowed the money at. So in this case, you're borrowing the money at 8%. You may only offer him 6%. I'll give you 6% interest and 10% equity.
So where would that equity come from though? Like be meaning like where like where would the equity
The
be
equity
applied?
comes from the lender. The buyer is paying you a monthly fee over and above 46 grand. You're not charging them for 46, you're charging them for 63. So if you did a PITI payment on 63 grand, I mean just a PI payment, principal and interest, right? I pull up my calculator and I put in 63,000 and what interest rate did you charge them?
Yeah, so I think it came out. I did this with Dane. I think it came out to like 13%, which I
Did
didn't
they
even
did they
realize.
give a down payment?
Yes, if she
How much
yes,
was it?
$4,000. Well, actually, $8,000 with the option fee.
$8,000 is what they put down.
Yeah, with the including the option fee.
Okay, is it a lease option or is it seller financing? Because it's not an
It's
option fee if it's seller financing. It's a down payment.
well, it started as a lease option, and now I'm moving her into seller finance. So
Okay,
yeah,
so that's going to convert over as a down payment. So she bought it for 63. She put 8 grand down, and she's borrowing the interest rate at 13%.
correct.
So on this formula, on this calculator, this is a mortgage calculator, right? Her payment's 608.41 on a 30-year fixed term for principal and interest. Okay. So
Yeah.
if you go to a regular calculator and you borrow $46,000, is it 46 or 43?
46
At 6% interest divided by 12, that's 230 a month.
to him.
Huh?
To him?
No. Well, right. If you borrow his money at 6%, it's because if he's going to be an equity partner, you borrow his money at $230 a month. That's 6%. So we go back to the other calculator and she's paying 608. So your equity is paid out over 30 years. So you're making 230, 608 minus 230 is, $370 a month, whatever, in equity that you're being paid over and above what you owe. So your cash flow is 370 a month. What's 608 minus 230? 608 minus 230. 378. So you're making $378 a month. But if he gets 10%, then he gets another $37.80. So he makes 230 plus 37.80. Right? Does that make sense? And you get the rest. That's your equity split over 30 years. There's no balloon payment. That's the only equity you get. The equity you created is the sale, the difference between 63,000 and the purchase price of 46. So you have $19,000 of equity you created, but you're asking to get it over 30 years. So in order to get 19,000 over 30 years, you're charging them 13% interest. So they're paying 13% per year over 19,000. So you're actually making more than I can tell you what they're going to end up paying for the house if you want to know, right? So on this mortgage calculator, you guys, you can go over to the timetables and you can look at the sum. And in 30 years, they'll pay a total interest of $164,000 at 13%. They're going to pay $219,000 for a $63,000 house. So you and your partner would have split $164,027 over 30 years. He would get 10% of it if he's an equity partner and a lender. If he's a 30% equity partner, then you wouldn't be paying a loan to him, right? You wouldn't be paying a monthly payment to him. You would split the 608 exactly at 3070. And you would do that for 30 years, and you would end up with 70% of 164,000, and he would end up with 30% of 164,000 if she carried the note out for 30 years. If she refinances you out early, right? That's why lenders and people put in prepayment penalties, because they're willing to make 19 grand in order to make 164. But if you pay me off early, I'm only going to make 19 grand. So people put in prepayment penalties, or they put in a balloon payment so they can do it over again. If you have a balloon payment and she's got to pay you all your equity in 3 years or 5 years, then you get this big lump of change in 5 years, and then she's paid you for interest 13% for 5 years, and you made more money, but you have another chance to go do it all over again. Does this make sense?
Yeah, I'm gonna need to watch the recording. I mean, yeah.
Well, so what is it you want to know to be able to convey this information?
I just want to figure out what I can offer him enough to make him move forward. Where I don't feel like, it's time sensitive at this point, for this current investor to be out. She's got a family situation, and I just need to
I'll tell you
get
what, in my experience, everybody's money is time sensitive. Everybody
right.
wants their money back on time. Everybody wants their money back immediately when they need it. And that's just part of it, right? Like, unfortunately, it just doesn't always work out that way. But as long as people are in as long as you're taking care of people with the obligation you paid, you know what I mean, and you're working on it, I mean, it is what it is. Her option is to foreclose, right? Which is going to take even more time and energy, and no one wants to do that. They just want to hound the borrower till they pay it. So luckily, you're a good person. You're doing the right thing. So the answer to your question, what to offer them is, when I borrow money, right, you should ask them what they want. Okay, what do you want? What kind of equity do you want? What are you looking for? Well, I want to be a 50% partner. So let me get this straight. You want to put in $46,000. I'm going to do all the work. I'm going to collect all the payments. I'm going to do all the foreclosure. I bought the house. I got the house. I got a lender. I found the buyer. And now you want to come in and just take out the buyer, take out the lender at 46 grand. You want 50%. Do you think that's fair? Okay, so what do you think is fair? Right? Oh, you want 30%. All right, so if I agree to do 30%, here's the deal. If there's ever an issue of any money losses, at 30%, you're going to cover the losses, right? I'm not going to lose any money at 30%. I'm giving up 30% of my equity, which in this case, if you think about it, we bought it for 46. You're only in for 46. We're selling it on a 30-year term for 63,000. If she carries it to term, we're going to make $164,000 because it's 13%. It's a good deal for you. Therefore, if we ever need any more money, you're the capital investor, you're the equity partner, you're going to bring in the money. We're not bringing it in together, right? So if we need 10 grand to fix a roof, I don't want to bring in five. Does that make sense? Now I could chip in and stuff like that. How's that sound? Right? So you're going to negotiate it, but I always ask them what they expect, right? If they expect 10% equity and you're willing to give them 30, then it's a win for you.
Well, I told him 9. So, and he didn't say no to that.
You
I just
told them
don't.
9% return or 9% equity.
I don't. That's where I'm confused because I have not had this conversation before. I told him 9% return, and then he started throwing out the equity stake word, and that's when I didn't know how to have that conversation yet.
There's there's and I've got to go. I got an appointment with my attorney at 10:30, so I'm gonna have to cut out a little early, everybody. I'm sorry. I don't know if anybody has any comments, questions, thoughts, and wants to contribute before I leave. And you guys can stay as well. Um, I don't know where Michael's at when he comes back on, but so here's the deal. Clarify whether or not they want to be a lender, an equity partner, or both, right? If you're going to give him 9% interest, that's a loan. Listen, I can give you 9% on 46 grand for 30 years. What happens if they foreclose? This is what happens. You're going to get your 46,000 back, right? Because I would initiate the foreclosure because they're not paying me money anymore because they're going to pay me and I'm going to pay you, right? They're not going to pay him directly. He's the lender, right? But if he becomes an equity partner, then they're going to pay us. They're going to pay me and you. The buyer will pay us. We will split it. We will split it 30-70.
So
You don't pay
first,
interest on, right? So he put in 46,000, right?
yeah.
And he wants 30% of the equity. 164,000 times 30%. He's gonna you got to put in the equity. So 164 minus 46,000. So your equity is you're going to make $118,000 over the course of 30 years. And he would get 30% of that. So he's going to make 35,400. So 35,400 divided by 30, he's going to make 1180 a year on 46,000. That doesn't even make sense. Um,
Mary, I want to see your notes.
Um, they're okay, really?
Yeah, I think the way you're taking notes might be contributing to the vagueness. And as a friendly reminder, a couple times on this call, you said, I got it. And then your brain closes. We need to say, I'm getting it. So it can keep coming.
All right, thank you for that. And my notes, yeah, are not super detailed.
But they very well could be with how much Bill's been laying out. So that's one opportunity there. And then something else too for everyone else listening is, you know how just in our regular everyday language, we will blend lender, investor, and partner. We just linguistically we blend them all, but they are categorically very different in what's expected, legal ramifications, claims to anything. And so maybe that's what's happening here is he's saying interest and equity, and he's thinking that they're meaning the same thing, like when we say lender, partner, investor. And now here we are splitting it. This is what it really means, but in his mind, it's the same thing. So something else to get clarity on. Does that make sense?
Yeah, absolutely. And that's a great point. I would have to I would have to rewatch. I have to rewatch this to take better notes again because I'm just trying to wrap my head around some of the stuff he's saying.
Okay. Awesome. So I'm gonna have to run, unfortunately. Um,
Yeah, solving
and I
problems.
wish I could talk more. But yeah, it's and it's really how you it there is a definite personal touch to what people define as equity and debt and or an equity partner. There's no, I don't know that. I'm sure there's a specific definition, and there's a, everybody in the commercial world knows exactly what they mean by equity. Um, but for the most part, equity is simply, again, defined as uh the difference between what is owed and what it's worth, right? And so you split that pot with an equity partner by percentages, and typically that's based on in an LLC, right? How many shares or how much contribution each person brings in, then they get a percentage, right? If there's $100,000 needed and you bring in 100, you bring in 10,000, you get 10% of the equity, right? So that equity is defined as, the sale of the property, what's left over, the profit, right? The monthly profit, the quarterly profits are split with the equity partners every quarter, and it's a distribution, right? So those types of things. So same thing here. But equity, when you buy into a business with for equity, you don't get your money back, right? Your money buys you your equity position, right? It's not paid back. You'll eventually pay your money back, and then you'll be playing with house money because enough time has gone by where you got your investment back, right? But it's not guaranteed. If the company goes under, then you lose your investment, whatever you got back at the time, and then it's gone. So like that's why equity partners take more risks. They're investing in the business. They're investing in you and the opportunity. It's yes, he'll have security in the property, which is even better. That's why real estate offers that opportunity to have security instead of having just security in people running a business, right? Um, there's actual tangible asset.
And Bill, and I
Yeah.
think the equity partners will also determine how you draft the agreement will determine what kind of say so they have in the business because they do have in sort of operation um invest. They want to see the investment succeed, so they do
That's
have some sort of
100%
control.
correct. Yeah, that's a
So
whole nother level that you're
yeah.
just talking about, right? An equity partner would be a partner they would have. When I write equity partners, however, I will tell you when I keep it simple with real estate is that my equity partners do not get a say. They can bring me their opinion. They can come learn. They can come walk the property. They can come as much as they want. They can ask me as many questions. They can talk to me as much as they want. But ultimately, I have every decision on how much I sell it for, what I do with the property, how I fix it, what color I paint it, all of those things. There is no partner in my partnerships, right?
So how do you say that to them
It's
on
written
paper?
in my agreement. You're going to have a
Yeah,
partnership agreement.
they have no say. Yeah, okay.
Absolutely. They have no say as to when I sell it, when I refinance it, who I refinance it with. They have no say in anything. They are not a decision-making partner because I'm the real estate expert. I'm the one who got educated. I'm the one who's running the deal. If you don't like it, I'll go find the money from someone who does. Most people in simple projects like this, they don't want to have that burden. They don't want to be the owner, or they would be doing the project themselves and they would be raising capital from people. It's different when you're buying in a business, and you're right, Steve, when you're investing in a company, you're like a startup and you got some bunch of kids, developing an app, you want to have a say in it. You got $1 million invested in it. That's a whole different world.
Mhm. And I do notice from the conversation, I've paid attention to some key opportunities that I think Tamara have missed. I think the position the guy is in is because there's Tamara does not know exactly what he wants to be able to position to communicate that effectively with him. What would that involve? Because you can get him everything he wants, but until you understand what he's looking for, it's hard to kind of create it for him. That's why you have the mixture of lending, equity, all these involved because you don't know exactly what he's looking for. So I think you should start back at base one and say, hey, I think we got off the wrong foot. We need to reevaluate this to understand exactly what you're looking for. Because until I do, I can't really make this deal make sense for you.
So, and you're right. That's 100% right. And unfortunately, she's under the time crunch. So the question would just simply be, can you just define what you mean by equity?
Yeah.
Define what you mean by your position.
And then be prepared to tell them no.
Yeah.
Because,
And offer a solution. Be prepared to
right, that
tell
would
them
really be
no
it.
and offer a solution. This is what I was thinking. This is what I consider equity is this type of partner.
And I
And
think there's a moment of education there right, as well, because then
correct.
that will position her as the expert, saying, "Hey, listen, I understand what you mean. If you ask for this, this is what it involves. This is what it require." For the example that you use, Bill, like, hey, if you come in and you want equity, and there's a problem with the property, these are your responsibility. Are you willing and able to meet those? Like, are you able to bring in that capital without scratching your head? And once
Mike,
you start
I'm gonna head out.
having those conversation, I think that will reposition who's the experts in that conversation.
And it will drastically lower your risk too, because, 6 months, a year, 2 years from now, when it's time to do the next step, if you weren't clear here, then your risk is going to be way higher over there.
Yeah, because then when you're looking for him, he's nowhere to be found,
Yeah.
or he'll be like, "I didn't know I had to put all this money or all this," because he didn't understand what equity partnership
Hey folks,
means.
I'm gonna take off. I love you guys. You guys can stay. I got a appointment in an hour. I gotta hit. I apologize.
Thank you,
Cool. Thank
Bill.
you, Bill.
Yeah,
Appreciate you.
you guys
Thanks,
are awesome.
Bill.
Thank you guys.
Yeah, Bill, thank you. It was awesome.
Now, I think this was a great masterclass in understanding because there's so many things involved in terms of what the person's there. The one thing's missing is clarity. Clarity as to what he wants, and then make the offer. Because I think it started the opposite way, where now he's thinking he's making decisions, but really he should be the one shopping, not the one being sold to. He should be convincing you why you should take his money. That's what I think the conversation should be about.
Yeah, and I appreciate yeah, I just have to figure out, I mean, equity stake. He's using the word equity stake.
As he's used to Wall Street. That's what his lingo is coming from. Because he's talking stake in the company. He's thinking stake in the company is the same as real estate, but it's not.
It's not.
It's not the same. So he's thinking Wall Street terms. Equity stake is, you buy into a company, you profit on the up, and you probably the only thing you risk losing is whatever you already put in. You're not putting anything additional unless it's stated exactly that on the contracts that if we need more money, we're gonna come back to you. But he's thinking Wall Street, not real estate.
So when are you going to call him, Tamara?
I mean, I could call him right now. I just, if you guys want to do this live, he's waiting for my call, essentially.
Yeah, as long as everyone else is sworn to secrecy, and if you're comfortable with it, then we can type some stuff in the chat. But essentially, your main mission is get clear on what he is
Once.
expecting by equity, and then you need to either say yes or no to that with a counter.
Mhm.
And then you'll have the clarity you're looking for. Then you can put it in black and white, send it over to him, and get your money.
Another thing also, what I wanna, what I'm hearing, because you are selling this as a seller finance, right?
Yes, it's already sold to
Okay,
seller
then there
finance.
should not be any because whatever the equity built in from that time, it's
Goes to
gonna
the
be the,
tenant.
the person that is buying this. It's not gonna be, your equity from this point on
Right.
when you close. So I don't know what he's talking about,
No, well, the
equities.
equity is already built in. So whatever equity Tamara created from the time she sold the property, those are the equity that can be shared.
Right,
It's
but yeah, but that is gonna be the purchase price.
Mm-hmm.
So it's the purchase price is going to be, that would be the principal, amount that this person minus whatever the down payment is, and so the equity is already built in there. So now, unless they're talking about what your balance is from the time you bought this property in the beginning, but that he should not be getting that if he's
Now,
only coming in.
if he wants that, then he'll need to bring more money.
if he
Absolutely.
wants
Yeah, he'll need to bring in
Yeah.
more money.
if he
Everything's
Right,
wants to
negotiable.
that's already the equity that you built in
Yeah.
prior to him coming in. So he should not be getting that. But again,
well,
depending upon what the need
what
of
he was
you.
asking about is if it forecloses, does he get the equity?
Well, he
No,
gets his money.
whatever
He gets
his
his
money
money,
is.
what plus whatever the interest that, that is being accrued, that's not being paid out, then he will get that. But other than that, he should not be getting it
So
unless you agree.
Yeah,
doesn't have anything to do with the equity unless he's coming in as an equity partner.
yeah. Technically, neither
Right,
do you,
right.
because it's sold, right? Like it was sold, it was seller
Hmm.
financed already. So whoever
Yes.
has title has the equity. Like you don't have the equity, and they don't have the equity.
You have a
The equity
profit,
belongs.
Tamara, but not an
Yeah,
equity.
you have a profit.
Right.
Exactly.
Right. I
Right.
mean, you get the equity once like if you foreclose it, then you get the property. Then at that time, again, if you're gonna keep that property, then whatever the appreciation of that, yes, you would ended up getting.
I think
So, and
a simple way to handle this is just simply ask the guy, hey, I've been thinking about what you said. When you talk about you want equity, what is it that you really want? What does that look like for you?
yeah, I mean,
Just
for
have
him to
him
do
tell
the
you.
deal, what would you want? What would you need to have for you to do the deal? And
Yeah,
that,
tell him because the house is already there. It's not going anywhere. And all he's doing is just replacing somebody that was already in the deal. So hey, listen, I don't know how much you told them in terms of, what's the deal is, but I would be like, hey, listen, when it comes to your money, uh, compared to the house, what is it that you really want? Walk me down what does the equity looks like for you, so that way I can paint a picture. And if it's something that we both can agree on, we can move forward. But if for any reason I see opportunities where I can make it better for you, I will go over these options with you and see what you think. And just make it in the terms of a win-win situation because you want him to feel like he's winning.
right.
Because it is has to be a win-win situation.
Right. I just don't quite Yeah,
Live
why?
call. Live call.
Yeah. You got this, Tamara.
Mara, you're
Just
trying to guess what he means before you call.
yeah. Yeah, don't even do that. Just
Yeah.
Just
ask him
call.
what he means. Just ask him because there's nothing wrong can come out of that.
Right. Right. All right, would you guys like to be on for this?
Yeah, we'll be on mute. Listen.
Yeah. Let's do
Ah,
it.
This is the perfect training wheels right there.
all right. All right. Hang on a second.
Go, 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 Tamara.
Do it. Do it. You can do it.
You can do it.
All right, I'm calling. Give me a second, guys. Yeah, sworn to secrecy, please. All right.
The mailbox is full and there is not enough space to leave.
He just texted and said he has to call me right back. I think he's on the other line. So, it's up to you guys, or I can pick it up tomorrow and just tell him we'll call him tomorrow.
Just say, hey, if you can talk in the next 5 minutes, great. Otherwise, tell me another time.
Okay.
And I changed the setting in Zoom so no one can unmute themselves if they're not a co-host.
All right, cool. Wait a second.
So, yeah, while you're doing that, this is one thing that Bill is excellent at. I'm good at, but Bill is excellent at, is when the person says their expectation right away, if it's not going to work, you squash it. In that micro moment, they don't like it. But in the very next second, they're over it. And if you aren't willing to squash that unreasonable expectation or something you won't do, then you're the one that starts suffering. So you got to be able to speak a lot faster in clarifying people's expectations.
Yes, I agree.
You know who else is really good at that is Cosimo. That guy is incredible with that. And for English being his second language with how good he is, very impressive.
Yeah.
And there's this book by Oren Klaff. He talks about, once you go a couple decibels higher when you're in any conversation with somebody, that sets you up as an expert, not just somebody trying to figure things out.
Nice. Yeah, carry around your decibel meter and make sure you're 3 notches higher than anyone else.
I think this is well, I mean, I just have to get more knowledgeable in this topic. Like, then I can, like, with things I'm more knowledgeable about, I can roll things out back a little bit quicker. So having this conversations like these are obviously good practice.
This is where the real money and the easy money is made. Fix and flips are great, but negotiations and contracts is your next evolution. So it's awesome to watch you go through this.
Yeah, thank you guys for the support. He has not written back yet, so
Okay. Well, yeah, maybe you'll have an update for us tomorrow, or later today. But the point
yeah,
is, you're moving in the right direction.
awesome. Thank you. That.
Sweet. Okay. Would anyone like to share what they've gotten out of this morning's call before we wrap it up? Oh, thank you for the reminder. Okay, you can unmute yourselves now.
There you go. There you go. So, yeah. Yeah, and also tomorrow, also find out what you want. I mean, what are you willing to give up? And because you got to be happy too, from what I'm sensing, you're not really happy. For one is you're not really understanding what he wants or what he means. And another thing, you need to know what you're willing to do as well. Because once you know that, then, then it would be easier to do the negotiation that way as well. And knowing what he wants and what you want. Being it's gonna be a win-win scenario for both of you.
Yeah, definitely. Yeah, I just have to understand what he wants a little bit more because he said he was okay with 9%, but I don't know if he wants equity. I don't know what 9% of, I mean, if he wants 9% of, yeah, I got to get more clear and I got to watch this recording again because Bill dropped some stuff that I'm not so familiar with and I want to get more familiar with.
Cool. Then yeah, after you watch the recording, which you can do on double speed, then show me your notes.
Okay.
I think interest is just like dating equity. You get into bed with them, basically. And you get a little bit of everything.
Right, the up and the down.
Yeah.
Can I ask a question about the equity part?
Yeah, go for it.
How does it change the conversation if the person in the other slightly different position than who Tamara is dealing with is also your learning partner and a Renatus student, but will be doing money lending, like a private money lender, and will be physically hands off. So cognitively participating, but from a different part of the world, meaning one being the operator doing the thing. How does that change the conversation of equity being appropriate and in what ratio?
Whatever you guys can agree on.
Yeah,
It has to be written out, and whatever you guys can agree on, the involvement, just spell it out, just how Dane always do. You know, I will do this, you will do that. When this happened, you do this, I do that. It's basically what you have to do.
So it sounds like basically deciding and documenting is the answer. So if that's the answer, what is the best source for a type of document, like a joint venture agreement that kind of helps make sure that if it's your first time
Lawyer.
doing it with somebody, that you're not missing many of the crucial things to document?
Real estate lawyer.
Okay.
It's whoever you have on your cabinets. I don't know if you went to the essential class where you learn to build your cabinets. And the first time you can start asking questions. I mean, you don't have to pay them up front. And you tell, hey, listen, I want to hire you for this, but I just have a couple questions. Are you okay with that? You kind of vet the lawyers, and then before you pay them. And once you kind of have an idea what you want, you discuss it with them, and then they'll help you structure it.
So what type of lawyer? Because my learning partner is a real estate lawyer.
Oh,
Yeah.
you need a different lawyer.
yeah, you need a different lawyer.
Yeah, you can't have them do it.
They're
I'll
a
get
real estate
another
lawyer,
lawyer
but in a
from your
different state,
side.
in a different area of real estate. They're we're both from a state where you use attorneys to close. So they use two closing transactions and short sales, not joint venture agreements, entity structure, stuff like that.
Right, you would want someone who has a little bit of experience with litigation because they have to be willing to defend anything they put in writing on your behalf. And like Mark Kohler talks about that, like he's understand real estate law, but he does never want to be in front of a judge. So you need the ones that want to be in front of judges.
Okay, sounds good. Do any of you have a recommendation of somebody to consult with or no?
Where are you located?
Near Salt Lake City.
Oh, no.
Nicole Cole.
Where's the property located? That's a better question.
Yeah.
Or I
So-
guess if you don't have a property.
The properties we've been looking at are Southern Salt Lake and Northern Utah County.
Okay, so basically
They
all
signed
Utah.
up for the first flip challenge in January. So besides running numbers
He's falling.
and
Sorry.
oops,
You guys want to listen?
Oh yeah. Okay, everyone on mute.
Oh,
sure.
Hey, Robert.
Doing,
Good morning. Fantastic. What about you?
doing good and getting ready to head to the dungeon.
The dungeon. What's that? Your office?
My job.
Oh, we didn't even talk. We didn't even cover that. You were just telling me. All the business ventures.
And, I trade. I practice emergency medicine as a physician associate. So
Oh, wow.
yeah,
We
I
actually,
don't identify as an entrepreneur.
wow, that's really, oh, that other guy brought up you working in emergency medicine, but you didn't talk about that at all.
Yeah, I mean it's cool. I like what I do, and it's very fulfilling. But that's part of who I am. It's not 100% who I am actually.
Yeah, and
So
just so I make sure I understood you correctly, did you say you're a doctor or you practice with a doctor?
I'm a physician associate. I mean, the name of the career was originally called physician assistant, and they changed the name to physician associate.
Okay, I'm
So
familiar with a physician assistant. I didn't know I did not know that associate. Oh, amazing. That's rewarding if you like that stuff and intense.
it's cool, I like it. It has benefited me financially very well. I mean, but I've been doing it for quite some time. So now it's like time for me to really like explore my passion, which is business and entrepreneurship and creating actually.
Yeah, that's beautiful. That's why we met where we did because we're all there as creators. And I'm really glad we're having this conversation too because we barely talked about my real estate community, but I would love to eventually introduce you to them because we're all like-minded individuals and entrepreneurs and real estate investors, and we're all creators. And I think you'd love our community out here. So let's have we have a lot to talk about. Let's have that conversation because I think you'd really like that. And you already said you would. But in the meantime, I wanted to get some clarity because, like I said, I was going to do yesterday. I've been um, getting some information that you asked for. So I wanted to just make sure I'm clear on what you're looking for. To be a lender or an equity partner.
Um, an equity partner would be the way to go because that's what I assumed was being proposed by virtue of getting interest payments from you. The only thing that was in question was if you were willing to go ahead and relinquish some equity of the actual property in and of itself.
So my question to you is, so I think that the terms that were a little mixed up. Now, like equity, you want the I'm looking for a lender. Do you want the responsibility of an equity partner, which means, you come in as a partner and you're responsible for the property, the like any more money that comes up, which now this is on seller finance terms, but that would be your responsibility on this. Or do you just want to sit back and collect interest and, not have to think about that?
I mean, I would like to sit back and collect interest. How would you classify that type of arrangement?
That's a lender.
It's a lender. Okay. So now, as a lender, typically a lender has some sort of collateral involved in the lending process.
Correct. You would be in first position.
Now, basically, it'll be limited to essentially the amount of money that I lended and not necessarily to the equity. First and foremost, did you clarify with your attorneys if you were obligated to pay any potential borrower that you made an agreement with? Would they be entitled to the equity of the property if they were to foreclose as a seller finance?
No, so no. So here's how that will go. First of all, as a lender, you would get your money back. You would get exactly what we agreed on back. You would have nothing to do with the equity. The equity goes to the tenant, and the money that what we agree on. So if we agree on you getting 9%, then you get 9% and your money back, and you're in first position, so you get collateral with the property. But if I would have to foreclose, but the equity goes to the tenant because they're buying the house. But regardless of the value of the property, you get your 9%.
A 9% flat rate.
Yeah, yeah, annualized.
Annualized. So I mean, like, please, let's just clarify that so we're all on the same page. So, all right, I was under the impression that so basically I'll be receiving 9% of my money annually.
Yes, correct.
So the 100 grand, without using 100 grand, if we're using 100 grand, I'm getting 9K a year.
Right. Yes.
For as long as the mortgage is on the right?
Correct.
So how long would this term be for? Or can I just hold on to that, that position as long as the tenant holds on to the mortgage?
If that's what we agree on, yeah. Happy to do that.
So now my only way out is to sell that actual percentage to somebody else.
No, because you're sitting back and just collecting interest, that would be my responsibility.
So I would essentially go ahead and just run in the model. So essentially what I would do is say, hey, Tamara, listen, I need the actual liquid capital. And then afterwards, then you will look for another buyer of my portion of the property, basically.
Correct. And you typically I ask for like 90 days if that's possible. But if you tell me that, then I'm going to make it a priority.
Right. Got it. Okay. All right. Let's see. And then you will handle all of the legal logistics as far as making sure that I'm a first lien holder.
Yeah, absolutely. I mean, and just to put it into perspective, Robert, and you get this because you're in real estate. I've already done all the work. Already done all the sweat equity, right? So I found but yeah, I've done everything, and I already have the attorney in place who does my paperwork. So like literally, I could get the paperwork to you by tomorrow.
So I tell you what, how about you send me the documents so I can review it and have my attorney look at it, so we can see how this deal is going to work out, and I can, instead of just bombarding you with a bunch of questions, because I have questions,
Yeah, no, well, that's good. I'd rather you ask me your questions if you have any more questions.
Essentially get to the point where, all right, so I'm definitely going to need to know the property information and things of that nature. Who is the current owner of the property officially?
It's still me. It's still me. I'm still officially I'm on title still.
Okay, perfect. Yeah, I need to get all that information. So I can feel confident moving forward, because
Absolutely.
Yeah,
Absolutely. Yeah, and just to give you a recap of what we just talked about, because now that we're clear, so basically, what you're doing is coming in, you're replacing my current lender on this property for $46,000. You'll get 9% annualized in return, and you'll be in it for as long as you'd like until you give me 60 to 90 days notice and say you need to be out, and you collect paychecks from me.
and that's the way to go, and essentially, what I want to do is review that percentage rate. That's the only thing, because again, I was under the impression that there were maybe some sort of opportunity to actually have equity of the property. So since that's out of the question, I need to see if there's any room to negotiate the actual percentage rate.
Gotcha. Yeah. Yeah. Okay. No problem. I'll send you that over. That's typically not something I open up until a little bit later once we get to know each other a little bit more. Um, but um, but I'm open to that in the future.
I just wanted to see exactly the whole mechanism of how everything's going to work. And then afterwards, then we could sit down and negotiate the actual interest rate and take it from there.
Yeah, okay, sounds good. I'll send it over to you. This is like someone just said to me, it's like this is a good starter property. And there's not it's a very easy, everything's already in place for you. So
It's initiating the dialogue and we're like fine tuning it essentially, you know.
yes. Yeah, exactly. And you're gonna add a title to your name, Robert. You'd be the bank essentially. You'd be like Wells Fargo.
Just I mean, that's why I look at it not just as an investment, but I look at it as an opportunity because this is something that I did want to get involved with. Essentially, I would be a hard money lender, you know.
Right. And just to put it into perspective, like I'm in a ramp up place. Like one of my mentors who's doing this has done over 200 deals. So I'm following his footsteps as much as possible. So my point being is there's room. Like that's why I want to say let's get one deal done and just get used to each other and then we'll keep going from there,
Let me ask you a question. What's the status of the property now? Has the mortgage already been put into effect, or are you still negotiating with her to actually, or with that individual to actually establish the mortgage?
No, so everything is in place here. So I'm getting her the paperwork. She had so just to give you some background, she's been an amazing tenant. She's so sweet. So just so you know, this is like it's people like her is why I'm in real estate. She found me and my property manager when she was living in a car. She got out of a domestic abusive relationship and was just not, so all she wanted was peace, right? So she found this house. She loves this house. She has gone above and beyond, taking great care of the house, never missed a payment. She got back on her feet. It was we gave her an opportunity. She got back on her feet. She actually works in a hospital. She does I think the radio oh I forget what it's called. Like the takes pictures of stuff. Not she's not a doctor or anything, not a medical, just a technician, I think. So she's just so good. She's endlessly grateful. She's never missed a payment. Like she doesn't complain. I'm like, is there everything okay? Like I have to call her and make sure I have to go there and make sure she's just like, she gives me all these gifts. Like I don't want gifts, like, but she's such a great tenant. So,
it's fine because the thing about it, like as a hard money lender, that typically doesn't really concern me because I mean, the payments are still going to be due, regardless if she has the mortgage, retains the mortgage, or defaults on the mortgage, rather, right?
right. So what's going to happen though? We're in the process of moving it over from we're in the middle of literally the middle of moving from the option into the mortgage payments. So I'm just getting the paperwork together for her. So that's where she is.
So now, well, once it's established, right, those payments are still due,
right?
Whether she retains the mortgage or she defaults on the mortgage.
Right. So if she defaults on payments, then I would be responsible technically to you.
It's a pop our T's and dot our I's,
Yeah, I no, I love it. Everything black and white, no gray areas. Yeah, that's right. Yeah.
So yeah, I mean, like let's see, and then what we'll do, just to give you the benefit of the doubt, let's go ahead and let's just call it a preliminary contract. Let's send a preliminary, so I can review it and have my attorneys review it, and if there's any other clauses or anything that I have questions about, then I can go ahead and review it, or if something that I want to interject into the contract, we can review it, just make sure that both parties are in agreement of that clause and take it from there.
Okay, beautiful. Sounds great. And yeah, and then just to reiterate, what you just asked will be in the agreement. So any for she didn't, if for some reason she defaulted on a payments, I would be making the payments. I would be responsible to make the payments. So that'll be in the agreement. So
Yep. So also, yeah. So we'll this is good. Again, I never claim to know everything. I mean, this is something new for me, but this is the reason why I'm doing my due diligence now by having this conversation with you, so we can lay everything out on the table, so both parties are happy with the agreement, essentially.
yeah, absolutely. And I just thought of this while we're talking, and then I'll let you go. But I actually have um well, you know what? Let's just keep the focus. But I have deals in the pipeline, but this is the time sensitive one. I want to make sure I honor the current investor because I know she's in a crunch like I would do for any of my lenders. So yeah, I'll get the paperwork over. And just a heads up, I am traveling. So
Sure, no problem. Actually, I'm gonna work today too. Anyway, I'll be off tomorrow. Oh no, I think I'm working tomorrow too. So, what's today? Today's Tuesday, Wednesday, Thursday. I'll be off. So Thursday, we can probably circle back, after I review the documents and things of that nature, and take it from there.
Perfect. Let me just do this. I'm gonna reach back out to my attorneys again now and tell them that we have to update the contracts. Let's just push it to Thursday just in case. I'm still planning on getting to you on Wednesday, but I'm just thinking with travel hiccups and I want to give a little cushion, but I have all these documents in place already. I just need to update some of the things that we're talking about. So it shouldn't be that bad, but let's just say Thursday and hopefully they'll be ready by tomorrow though. But otherwise, yeah, good stuff, Robert.
Basically, you did go ahead and clarify with your attorneys that you are obligated to go ahead and pay the tenant if she was to default the loan. You would have to pay her the equity.
Well, I wouldn't pay her the equity, but anything between essentially let's just say now and as the property moves into her name, and let's say she were to default in 2 years, would go to her because it would be her property.
If there was equity to be made,
It's going to go to her because the property would be in her name.
if there was equity, and that's only if you sell the property for a higher amount.
When I get it back, you're talking about.
Yeah. So what's the loan amount, basically?
The loan amount on the property is 63,000 off the top of my head.
So 63,000. 63,000. If she defaults, and let's say the market crashes, and let's say, for instance, there's just no movement in the actual price of the house. If you sell that property to somebody else for 63,000, you don't owe her anything. You understand that, right?
Yeah. Well, hold on. Say that again. Yeah, I think
if she defaults on the loan,
and I take the house back,
and you get the house back, and you resell it to a different buyer for the same price because the market didn't move, and let's say, for instance, the property even lost a little value, and it just balanced out to 63,000 again.
Right.
You don't owe her anything.
Right. She just gets what we have on paper right now.
Well, she gets.
Oh, because she's defaulting. Yeah, she gets nothing. Yeah. Yeah, she's defaulting. Yes.
She's defaulting. So she's, again, because the fact of the matter that the contract is for $63,000. If she defaults on it and the price of the house hasn't increased, she actually owes you money. But it's up to you if you're actually going to go after her for that, and most likely you're not. So because it's not gonna be worth your time or money. But it's just good to know that there is a way out of this, of owing the equity on the property to a tenant that has defaulted. So
Yeah.
just food for thought, you know?
Yeah. No, I got it. And I appreciate you bringing up these points. But we've
If you happen to know anybody who is in default because of my business of entitled assets recovery services, please feel free to let me know so I can help them recover that, you know?
yeah, for sure. Yeah, definitely. I'll keep it in mind. You've got a lot of things going on. So it'll be fun to start doing some business together. So all right, good. So I'm gonna get those documents together for you. Let's touch base on Thursday and we've got this we'll wrap this all up.
Sounds good. Have a good day. Take care, okay?
Thanks so much, Robert. You too. Great speaking. Bye. All right. Thanks for all the feedback.
That was
Yeah.
great. That
Well
was great.
done.
You got, you got what you wanted. At least that was a great clarity that you actually had. So now he's just, concerned about that 9%. So I want to make sure he gets the money. So I think, he's good with that.
That
Yeah,
was
I
an
think
excellent dollar per hour too.
it was an excellent what?
Dollar per hour.
What you
Oh,
earned
You
on
just made
that
a lot of
call.
money on
what?
in very few minutes.
Yeah.
Oh, yeah, yeah, yeah. Oh, yeah.
Yeah, I think another thing that he was concerned, like if you foreclose on the property, now, I know he was using the 63,000, and if you sell it after you foreclose on it, it's you sold it for 63, and it means the borrower doesn't get anything, considering, because you have to also take into consideration the principal that's paid down. Like, what if you don't foreclose until 15 years? So then there's going to be more that has paid down. And plus, of course, you have to minus the whatever the attorney's fees, or what you incurred for, like, for foreclosing and stuff. So at the end of the day, I mean, technically, whatever's left over, it would still go to, the borrower. So he's still not gonna be getting anything, or you're not gonna be getting anything except for the principal that you started in the beginning, minus, of course, the money that you already got.
I think he is looking for a higher return. Yeah, he is. That's why he was asking about the equity. Yeah. No, this is a lot of stuff I haven't thought through yet. So I appreciate everyone's support and backing me up. Thank you guys so
But
much.
notice how easy the conversation is when you're
Mhm.
asking him questions instead of thinking for him, right?
Yep.
Because you struggling when you're thinking for the person, but when you ask questions, you get the answers. And I think that's a good observation to make because you were worried of how to keep him into the game. But when you ask him the right questions, he tell you what you need to do to keep him in the game.
Yeah, exactly. He tells me yeah, exactly. Asking good questions. Yeah, I got it.
Yeah.
That's something I'm getting better in the habit of. But yeah, asking questions are great. It made it flow a lot quicker.
Right. And plus, you got to think, you're in charge of this one. He's fortunate that he'll be investing with you. So
Right.
you're in control with the situation.
And did you hear his voice when I said, just to put it into perspective, I already did all the work essentially?
Yep.
His voice changed.
Yep. Because
Mm-hmm.
he was super worried. And then you went, oh, you've already done it all. Cool. Well, then I can just sit back and collect a check.
Right.
Right.
Good job.
So, and I think that was a big, it shifted too, because now he's thinking he wanted the equity part and also that 9%. But then when you told him about you're going to be paying all this thing if we need money and stuff, and doing all these things, then he really did not want to do it. So he really just want to be lazy, sitting on his couch and collect the money every month.
That was the position that put Tamara as an expert because
Mm-hmm.
when he asked, what does that mean after? Because you remember when you have to explain to these people sometimes what they want, what it means. Because when you ask them, what do you want? Do you want just to collect the payment, or do you want to be responsible for all these things and they happen? And he's like, no, I want to collect payments because that's usually the easiest way out. Now you explain it to him, he understand it. Now he's like, okay, so she knows what she's doing. basically.
Right. Right. He just threw me off the way he was asking the questions we had yesterday. And I wasn't asking the right questions back. So that's why it,
People with money always want to feel smart, so they're gonna ask you stupid questions.
yeah.
And he does have knowledge too, because you remember the questions he's asking. If he does not have, some sort of education, he wouldn't be able
Yeah,
to
but he
come up
wants
with
to
these
feel smart,
questions.
so he's gonna ask stupid questions. He doesn't care what they means, what they entails in the real estate, or how they implies. He's gonna ask to feel smart, sound smart too. It's just a
Mhm.
money thing. It's not
Right.
even. It's just a money thing.
Yeah, and especially he asked the question even down the road, through foreclosure process and
Well, he has real
what would
estate.
happen. Mhm.
He's not an educated investor. I gathered that much, but he does have real estate. He just got lucky. He bought a bunch of properties like 15 years ago in a place that's really hot now.
Oh,
But
wow.
he's not educated though, because I know that, but he did his own education. He has done some of his own research. He's a smart guy. He's a smart guy and he's a business guy, but he's not an educated real estate investor, if that makes sense.
Mhm.
He
Perfect.
doesn't,
Well,
yeah.
yeah, he wouldn't be, because if he thinks 9% is a good return, definitely is not.
That's only 2% over the money printers at Federal Reserve. Remember, they're kicking out 7% a year in inflation and monetary debasement. So, folks, you're not going to tell it to your lender, but you need to understand that this dude's only going to get 2% gain on the equity because of the currency debasement over the next 12 months. All right,
Don't get Michael started.
7% is the hurdle rate.
Yeah.
7% is the hurdle rate.
But it's still a win-win. It's still a
Still a
win-win because
win-win.
he's still
Exactly.
getting more money than what he's getting now. So,
Yep. Yeah. And if he doesn't put the money into the deal, he's going to get -7 by just doing nothing.
right.
So,
Exactly.
And
anyway, good job.
That's the one.
yeah, I have a deal right behind this. I just didn't want to bring it up and him to go in. I wanted to focus
Yeah.
on this. Yeah.
Good job. Good job stopping yourself because I was like, oh no, she's going to throw in another variable, but you controlled it. So good job.
It sounded like, she had almost an inkling in there to tell.
Yeah.
Then I pulled back. I
Someone
pulled back.
commented like,
Yeah, you
"End the
did. You
call,
did. Great job.
end the call."
Yeah, like, pull the
What is
plug.
that?
Yeah, I think
Oh, good.
maybe Michael probably would have disconnected the call now. Just kidding.
Take her
We just
phone.
talk ourselves out of the deal
Yeah.
sometimes.
That's
Good
why
job.
I went back. I went back. Pulled back.
It worked,
Yeah.
guys. Well done. So this is an example of just what we do every day, right? These are the
Right.
conversations that Dane has too. It's the same thing. We're just going to need to do it dozens or hundreds of times to get to the tens of millions of dollars that we want. But this is a perfect example. So well done, Tamara. Thank you for being open, being coachable, being vulnerable, and going for it, chasing your dreams and facing your fears. It's wonderful to watch.
Yeah,
Thank
Michael,
you.
before you
Always appreciate
disconnect, I want to ask something else.
Go ahead.
Okay, I've heard from Scott this morning on Impact that the E3 in February we're having some kind of watch party here. So could you tell us a little bit about where is it gonna be, at the hotel, or where is it gonna be? Is it at the corporate, or what's the setup of this one? Is it different from the last two? I mean, I know the first one was our national, so. And another thing is, this February, is it going to be our nationals, or are we still going to have a nationals in March, or where are we with that?
Nationals will be next year. This year's leaders retreats. Those two things are going to alternate.
Oh, okay, okay,
It's going to be this E3 in February is going to be a corporate. It's going to be
okay,
limited to 250 people. It'll be 200 in the main seat, 50 people upstairs. So instead of everyone trying to travel in and cram, we're going to encourage you guys to do office watch parties. Bring your guests, bring your team members, have the experience there, and then make your sales in the room.
okay. So the speakers were just gonna be like, I know Scott, Nancy, and Bob. Tierney normally they speak at the E3. So are they just gonna be speaking through online instead of coming there in person?
I don't know exactly their involvement in the E3 as instructors and trainers, but
Mm.
definitely having them in your guys' room locally is going to make way more sales.
Yeah, yeah, absolutely. Absolutely. So, okay. All right. Great. Thank you so much. That's what I was thinking. I was like, okay, so this is a different format than the past, the past ones.
Yeah, we want to have a Florida watch party. We want to have a Phoenix watch party, a Seattle watch party, and get people to, and whether you do it at your house or go get an event center like you guys are doing. Um, that way we can maximize the impact across the country and,
I'll have a
start
Spain.
And again, we just paid in
and in Spain.
197.
A Spain one. Gotta have a Spain.
Yeah.
199
Oh,
because
199. I'm sorry. 199, and then we can invite as many people as we want in person and online.
correct,
Okay.
correct, and that's the early bird price. It'll go up to
Correct.
250 last week of January.
Okay.
So get that early bird.
And tickets are up
Uh,
already? Or not yet?
I don't know.
I can check.
Go look real
All
quick.
right.
all right. Well, thank you so
Will it
much.
be recorded?
Yes.
Like, okay, good, because I want to be in the middle of the ocean on a cruise with a bunch of people
Yeah.
and want to
for you.
watch it when we get back.
Nice.
Get that Starlink.
Yeah,
There you
there
go.
you go.
We're talking
We have
about it.
Wi-Fi on the cruise, so you can watch it on the
Yes,
Oh, you
cruise.
don't want
right.
cruise Wi-Fi
It's
on
it's
no.
$400 for it.
Oh,
No,
really?
get your own
We're
Starlink.
Yeah,
we're
dude.
talking about it. There's several of us
Starlink.
that are going to be on it that are from the group. So we're talking about it. But I just want to know if it's going to be recorded. Might be the better way to buy the recording and go that way.
Yeah, and then just be
Uh,
present for your cruise.
bring your Starlink.
That's what I did. Only $50 a month for Starlink.
Yeah, there you
Oh
go.
yeah, pretty cheap.
But the
Can you
cruises no
pause
longer
it?
allow the Starlink
Is there a
setup to
cut?
go with you.
Oh
Really?
really?
Yeah.
They got on. They caught
Yep,
on.
they got caught onto it, and that's why the cruise, at least Norwegian and Carnival, they you have to buy theirs because it is Starlink.
Mm.
Oh, gotcha. Okay.
Yeah.
Oh, you're hugging
Otherwise,
bandwidth.
yes.
But then you're sharing bandwidth. Yeah.
Yeah,
Can you
interesting.
do it like if you only need it, like say if I'm going on like going to a different area and I want to bring it, can I just get it for that 1 month, or are you going to pay like the monthly? Is there like there's no contract to that, right? You can just get it like on a month-to-month basis. Is that
You could do month to month, but you still got to buy the device.
the equipment, right? You have to have the equipment, correct? But once
Yep.
you have the equipment, like say, okay, I really don't need it this month or next month,
Turn it off. Turn it
turn
back
it off.
on.
There's ones that
Okay.
fit in
And
your
you
backpack now too.
and you don't have to pay for that $50.
Right.
Okay. All right, that's good.
Yeah.
AT&T has it's $20 a day international that we're going to use, and the boat, so we can use it through AT&T. That just turns on. You just turn it on your system, your phone or whatever, and it does not charge you unless you leave the United States. Then it just automatically does it if you go to internet, text, phone call, or whatever. Otherwise, it just sits there, so you don't have to remember to try and use it. That might be an option for you instead of the actual Starlink, unless you're going out into like super remote spots
Like Middle
in the
Tennessee.
mountains.
Yeah, right. Yeah. Right. Like McMinnville.
Awesome. Well, thank
No,
you
that's
guys and
beautiful.
gals.
Where you are,
Yeah,
Mako. That's awesome. Yeah.
cool. Well, what a fantastic morning. We went above and beyond expectations. So appreciate you all, and
Yeah,
we'll
that's
see you
good.
tomorrow for another exciting episode. Have a great day.
Yeah. Thank
Mwah.
you.
Bye.
Thank you, everybody. Thank you.